Hello, and welcome back to the Fintech Takes podcast. Today we have another episode of Fintech Recap featuring the one and only Jason Mikula, author of the Fintech Business Weekly newsletter. It's July, and so we are recapping what happened in June in the fintech ecosystem. Jason and I play the hits. We talk about buy now, pay later. I get to do a whole thing on the FICO score and FICO's new BNPL versions of its score and what that means for the ecosystem. We, of course, make a trip to BaaS Island, where news of a rescue ship maybe making it to evacuate folks is the new exciting update from BaaS Island. So Jason gives us the details on that. We talk a little bit about Bill Pulte and the FHFA, and apparently the ability now for people with crypto assets to use that crypto to get a mortgage. It doesn't necessarily seem like the greatest idea, but apparently we're going to do it anyway. And of course, as always, Jason and I wrap up with some things that we can't let go. Before we get into the podcast, I also want to mention that coming up in a few weeks, we are going to be hosting another edition of Fintech Office Hours, which is my monthly live digital event where, kind of similar to Fintech Recap, we talk about stuff that's been happening in fintech. We answer questions, we have discussions. Normally, it's an event that is only available to Plus members of the Fintech Takes network, but we are blowing it open and doing an open house in July for everyone to join, whether you are a member of the Fintech Takes network, which you should be, or if you're just curious about what's been happening in fintech. July, we're going to be doing an open house and talking about a lot of stuff happening in fintech. You can find information on that on fintechtakes.com or watch for information about that event in the newsletter. So with that out of the way, and without any further ado, let's jump into Fintech Recap with Jason Mikula. Okay, Jason Mikula is here. Jason, how are you?
I have recovered from my jet lag, despite the bleary look in my eyes. That's because I just took out my contacts. I am doing well. Back from a relatively brief trip to Mexico City, where I'll admit I still don't understand how real estate transactions work. And a brief
Man, if you
trip,
don't understand, no one does, honestly, at this point.
Maybe not entirely for public broadcast, but the counterparty was also a banker, works at, I think, Barclays. And so it's just a very interesting interaction of me being like, I don't understand why there's no escrow here. Like, what? And then
what
a brief trip to Chicago to see my family, and back in the mostly cold and rainy Netherlands. You've been traveling as well, yeah?
Yeah, I actually more travel for fun than for work, which is kind of unusual for me. But just
you were in Yellowstone, right?
I was. I went to Yellowstone.
Maybe as a kid.
Maybe as a kid. I mean, it's a huge park. So if you were there, you were probably like asleep, and your parents were just driving through. Like it's a massive park. It's the biggest one. First national park, not to brag, but Yellowstone is pretty awesome. And it's kind of funny because you take it for granted, as with anything that you like grow up near and is in your backyard. You're like, it's right there. And I actually hadn't been for a while, and my 7-year-old was like, can we go to Yellowstone? I was like, well, actually, that's a request I can actually say yes to. It's relatively easy. We stayed a night in the park. And it's actually really awesome. And my two takeaways from Yellowstone are, one, you have to really be on your toes regarding wildlife, because we were driving on this little 2-lane road, and there was a bison that must have weighed 2,000 pounds that was laying, not dead, just asleep next to the road. I swear to God, an inch away from where cars were going, just not moving. And so there is wildlife all over the place. We actually saw 10 feet away from our car, a grizzly bear cub, which is very, very unusual. I've never even seen a grizzly bear at all in the park, let alone a cub. 10 feet away, we stopped for the briefest moment to see it before we drove as fast as we could, because you don't want to run into a mother grizzly bear in the park. So lots of fun wildlife. And then also the other tip for all aspiring Yellowstone visitors is just get up early. The beautiful thing about national parks is there's no hours posted. Once you're in the park, you can get up whenever you want. And so I channeled like my dad's kind of like travel psycho energy, and I hustled those kids out of the hotel room at 6 a.m. in the morning. We got to see all this stuff without crowds. It was amazing. So like I felt very proud after our Yellowstone trip.
we all turn into our parents eventually. It's okay.
Yeah, no, I mean, it was, I was like, I was going to the hotel room, I was turning on lights, I was clapping, I was yelling, I was like, oh my God, I've turned into my father. So we definitely got that checked off. We have a little bit more fun travel coming up soon, and blessedly little work travel this summer. So I'm excited for a little change of pace.
Well, speaking of change of pace, there are some changes coming to the FICO score, or I guess already rolled out. Do you wanna walk us through our first story?
I will, Jason. I count on you for magnificent transitions, and you didn't let me down there, so thank you. Yes, our first story we wanted to talk about was the FICO score getting an update. So FICO announced that it is going to be rolling out 2 new versions of its score. Currently, the most recent versions of FICO are FICO 10 and FICO 10T, the T standing for trended, which takes into account trended data over time. Both of those scores are getting an update that will incorporate BNPL data. So this has been a long time coming. We know from a lot of reporting that's been done that the credit bureaus, acting, I think, at the behest of lenders, have been trying to get BNPL companies to furnish data so that lenders, non-BNPL lenders, can get a sense of just how much BNPL activity is actually happening, how it's affecting the credit worthiness of their borrowers. It's kind of been a bit of a black hole. And so FICO has been trying to address that. The score is trained on data from 500,000 users that were sort of shared with them in a joint study with Affirm. And essentially, the idea is that this model will group together multiple BNPL loans over a short period of time, over a defined period of time, into sort of a single installment loan that will then factor into the FICO score. So a couple things about that study that I mentioned with Affirm that they released a little while ago. What they found was that the FICO score impacts were generally consistent with the opening of a new account, meaning that when you open any new account, any new revolving account, installment account, there's usually a bit of an impact, but usually it's within plus or minus 10 points for the majority of consumers. For the majority of consumers who had recently obtained 5 or more Affirm BNPL loans, they either saw a increase in their score or no changes in their score for the majority of those folks. And the impact on FICO score's predictiveness was moderate but useful. So overall, sounds promising. Definitely a move in a positive direction. But Jason, the thing I want to talk about here, and I'll be honest with you, the thing that kind of made me lose my mind a little bit when I was reading the mainstream media coverage of this story, was that I didn't really see a lot of discussion on the sort of chicken and the egg problem, which is, hey, this is great that you're building a score that can take this data into consideration, but you have to have the data. And that's a kind of an important component to this. And most of the stories that I read pointed out that Affirm is now furnishing data to Experian and to TransUnion for all of their pay later products, both their installment loans as well as their pay in 4 products. Great. However, there seems to just be this assumption that all of the other BNPL providers will just follow right behind Affirm in doing this. I don't think that's a good assumption because, as you and I have talked about many times on this show, Affirm is very different than other BNPL providers, right? Most of its business is actually installment lending, not pay in 4. It serves a much more affluent and creditworthy customer base for the most part. And I don't think Affirm really had much to lose in furnishing this data to the credit bureaus. I do find it interesting that Equifax is never mentioned in any of these deals. I'm not sure what they're doing, but at least Experian and TransUnion are going to have Affirm data. Great. That doesn't cover the entirety of the market. And in fact, I would argue that doesn't even cover the most important part of the market, which is the larger pay in four universe, particularly for consumers who are new to credit or who are subprime credit risks. Those are the folks who are more using Klarna, Afterpay, Zip, maybe PayPal's pay in four product. And none of that is getting furnished to the credit bureaus. And I don't think it's like fait accompli that it will be furnished to the credit bureaus. There's no mechanism to legally force them to furnish data to the bureaus. And I can tell you the bureaus have been putting a lot of pressure on them, and they've been resisting that pressure. So I guess, Mikula, my question for you is, how big a deal do you think this announcement is? Do you think we're on the cusp of better understanding BNPL users' credit risk, or is this more kind of sizzle and no steak?
If those are the buckets I have to choose from, yeah. I would say this specific piece of news is probably more sizzle than steak. So I was double checking to confirm exactly what you just said, which is, as far as I'm aware, it is only Affirm that is furnishing on Pay in 4. In fact, and I find this almost a little bit difficult to believe, apparently Klarna only began furnishing on term loans last November.
Yes.
And does not furnish on the Pay in 4, Pay 30, or of course the Pay Now. And so I think, something that I guess unsurprisingly is missing, like a piece, the nuance that is missing from the mainstream media coverage is, this is really, kind of like a complex game theory situation for the BNPL companies. I think, from an outsider perspective, you'd be like, oh, well, why wouldn't you do this? Of course, like, this is how it works. But the reality is, there's a whole lot of incentives for the companies not to furnish. I mean, one, it's complicated, right?
Yes.
I do not want to start talking about Metro 2.
Frankly, I could do a lot on Metro 2 if you want, but we shouldn't for the sake of
I don't think
audience.
everyone just will turn this off immediately if we start talking about Metro 2.
Yeah.
It's antiquated, it's complex. By furnishing that data, they open themselves up to regulatory risk as far as compliance with the Fair Credit Reporting Act, including the need to have customer dispute processes in place. So, what's this weird trade line that showed up on my Credit Karma report? Like, I don't know what this is. I'm gonna dispute it. And particularly, gamification, perhaps in the bad way. As far as how many services have popped up to streamline consumers, either legitimately or in some cases illegitimately trying to influence or manipulate their credit score, you can dispute trade lines, with one click through services like Credit Karma, I believe. And so if you're a buy now pay later provider, what is the cost benefit to furnishing? I mean, the number one ostensible benefit is that it should improve repayment, right? That's why creditors furnish to the bureaus. That is the reason. It's the stick. Mm-hmm. And in fact, I mean, I know probably everyone listening to this is aware, but you have to pay to furnish into the bureau. So it's like the benefit is this is a stick to encourage repayment. And then there's all sorts of expenses and cons and complexity that go into that. Yeah. So to your point, if you're a firm and the majority of your business is and has been term installment loans where, furnishing has been part of the recipe to ensure repayment, and a firm has been, quite savvy and diligent at managing credit risk, versus a company who's more heavily exposed to the Pay in 4 product, like the pros and cons may not line up there. And then something I'm curious to hear your take on, some consumers actually view it as a benefit that these types of products are not furnished. So, I mean, when I was in payday lending world, that was actually a marketing bullet point, right? Like no credit check, like we're not hitting the traditional credit bureaus to underwrite this product. And on the flip side, it's not reported or not furnished. So like no impact for applying or no impact to your credit score from taking this loan. And for people who had in that space, it was typically bad credit. That was a sign that like, I'm going to be able to get this product, but also if for some reason I default, I'm not able to pay this back, it's not going to damage my credit more than it already is. And I think people in the prime, super prime space, don't necessarily think about that, but I describe it as essentially like an off balance sheet debt.
Yes. No, I think that's exactly right. I mean, so what you're touching on is this distinction, I think, between the sort of theory of who uses BNPL and the reality of who uses BNPL. And you and I have talked about this before, right? The CFPB published some data based on a study they did from BNPL providers' data. And what they found was that I think the sort of myth of BNPL is that it's like a new to credit tool, right? Like I've never used credit before, and instead of using credit cards, I'm going to use Pay in 4, and it's going to be a totally different and more financially healthy track for me to get on as a 18-year-old. And this is just the way I'm going to get onboarded into the credit system. If you sort of buy into that idea of BNPL, specifically Pay in 4 BNPL, then you might think, well, the BNPL providers should furnish to the credit bureaus because they are the on-ramp for these young consumers, these new to credit consumers into the US credit system. And one of the benefits of their product can be, we can help you build your score and we can do all these things. Isn't this great? That's, I think, one sort of logical construction, but it's based on the assumption that the primary users of Pay in 4 BNPL are new to credit consumers who are choosing it instead of going down the path of using credit cards. What the data suggests is that it's actually much more common for subprime consumers, for consumers with damaged credit, for consumers who have credit cards, multiple credit cards with high levels of utilization, to use Pay in 4 BNPL as an additional source of liquidity, right? And for that population, what you just described about the benefit of this doesn't impact your credit score, that is hugely valuable to those users, right? And so I think you're right. A huge reason that you don't see a lot of Pay in 4 providers, and again, Affirm is not really a Pay in 4 provider. They offer it, but it's not their core business. For someone who it's their core business, like an Afterpay or a Klarna or a Zip, your core business is in catering to consumers who want that off-balance sheet sort of shadow access to liquidity that doesn't sit within the sort of universe of credit bureaus and credit scores. And I think the other thing that I've been thinking a lot about, and I'll bounce this back to you real quick, Jason, is I also think that a lot of the credit bureau's model, and it's kind of funny you're describing like, hey, do all of this work and take on all of this compliance risk and pay us to give us data. Like, it's kind of a really bizarre thing to say out loud in 2025 when, companies are digital by default and they view data on their customers as one of their most important competitive assets, right? And I'll pick on Klarna as the example here. Klarna has this model where when they expand into a new country, their loss rates go up, right? And what they say is, this is part of our formula for growth and for expansion. Our model is we go into a market and we use this sort of short-term, low-dollar structure of Pay in 4 to basically do a mass experiment on consumers in that market to sort out goods from bads, right? And so we give everyone, a $200 loan to buy a pair of tennis shoes, and then we find out which ones will pay us back and which ones won't. And we don't really care how that's correlated with their credit score, their history of using credit. We sort of build our own model of good payment performance in this country. And then, what it does tend to happen usually is that their loss rates go down, right? Because they don't continue to make loans to the customers who aren't paying them back, but they do make loans to the customers that do pay them back, even ones who have low FICO scores or who don't have access to traditional credit products. That's a competitive asset, right? They don't want to give that data to the rest of the market. I think the way Klarna looks at it is, we know who the diamonds in the rough are that we can lend money to and help merchants sell their products to. We don't want to give that insight away to credit card issuers. We don't want to give that insight away to JP Morgan Chase. And if we furnish data to the credit bureaus, that's exactly what we're doing. And so I actually think it's entirely possible we might see Pay in 4 providers sort of work together to come up with a different model where it's more like, hey, how do we have some kind of consortium or data sharing to stop like flagrant loan stacking, to stop first party fraud, to stop people who abuse the pay in four ecosystem? But let's do that separately than just giving our data away to our competitors, which doesn't make a lot of sense to us.
No, that I mean, the idea that first party data, as an asset that you don't want to essentially devalue by making available to everyone else, entirely makes sense to me. I mean, I need some new stories and some new touch points. But it's like when I was at LendUp, which keep in mind was 10 years ago, we actually wanted to furnish the short-term loan data to the bureaus. At the time, it was the general bureau's policy that they didn't accept trade line data on loans that were like less than 30 days of duration. So even if we wanted to furnish, which we did, we were not able to. And the concept was, okay, well, we'll take this first party data that we have, and similar to what you described as Klarna's approach, understand sort of who's been de-risked because we've seen them borrow and repay, and who's borrowed and not repaid, and sort of definitionally like is risk. And then use that to sort of expand the eligible loan amount and potentially products over time. So certainly that as a strategy makes sense. And I mean, to your point, if Klarna, is able to get its losses to a point it's happy with, at least in the current point in the cycle, blah, 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 without the stick of, we're going to report you to the bureau, then why would they? Like, what's the upside?
Right. I mean, that's the thing I kind of keep coming back to. And I think the other thing that the bureaus kind of lost track of over the years, and it's coming back to bite them now, is they have at other times in their history enforced more of a rigid pay-to-play model or give-to-get model, where it's like, hey, if you want to get data from us, because a lot of these BNPL providers pull data from the credit bureaus. That's the other thing. If you want to get data from us, you have to give us data, right? Like give-to-get was kind of the model. What happened, I think, particularly as fintech sort of exploded, is the bureaus kind of loosened the restrictions on that, right? And a lot of what ended up happening was they sort of bent the rules in order to monetize fintech as a category. And we saw this in a bunch of different ways, but one of the ways was kind of loosening up this restriction on the give to get model. And that used to be how the bureaus would enforce more of a data coverage, was if you want this data, you have to contribute to this data, which is actually in a lot of ways fair and logical and symmetrical. But, capitalism sometimes warps those incentives. So I think that's interesting. The other one that I was thinking about, and is something to watch, is open banking is potentially a way to get around this a little bit, because you can derive certain attributes, maybe not everything you'd want to know, but a lot, by looking at bank account data and seeing, oh, hey, someone bought something and they just made a payment to Klarna for 25% of this thing. We can reasonably infer that there's going to be more payments, and we can sort of backwards engineer a rough understanding of their usage of BNPL by looking at bank transaction data. It's not perfect. There's some concerns about like reject inference, where you don't know what happened to consumers who were rejected for loans. So like there's some sort of challenges there. But in general, bank transaction data could be a useful way to do this. Here's a little thing, though, that, again, illustrates your point about these companies not wanting to play nicely and share. It's really hard if you're using Plaid or you're using MX or you're using Finicity, connecting your BNPL accounts. It actually doesn't have very good data coverage. And so again, you see these companies really proactively using these tools, open banking, the bureaus, to get data. But if you try to connect your Klarna account in a PFM app, you're going to have a hard time, right? There's actually not very good coverage. And now that 1033 might be getting revoked and vacated, there might not be any like legal or regulatory mechanism to force BNPL companies in any sphere to share their data. So I think that's potentially another area where you could see a solution, but now we might not.
No, that's it. I had definitely considered the idea of the bank account transaction data as a solve for not having visibility on the bureau, right? I mean, if you're some other potential creditor underwriting this applicant, you pull bureau data, these trade lines aren't there unless it's Affirm. Like, to your point, if it's the same checking account and they're using that for Zip, Klarna, whatever, you should see that transaction data. Maybe it's not, as robust or as easily digestible, but like you still have an idea of like, what is this person doing? How's it impacting his or her cash flow, even if it's not showing up in that bureau data. And again, this was true in the small dollar spaces as well, And again, even 10 years ago, when open banking infrastructure was not as robust as it is now, like you could pull that and see like, oh, this person has 10 different payday loans with 10 different payday lenders versus, at least on the account that they've linked, like we don't, maybe you see a credit card payment, but you don't see that kind of activity. I had not considered the interesting idea / apparently challenge of actually linking directly to a Klarna, a Afterpay in the same manner, and particularly I don't want to say post 1033 because we're not there yet.
We're not quite there yet. No, I know we're not. Knock on wood. Maybe something will save it. But no, I think the interesting thing, and I've been banging this drum for a while on the open banking data coverage, is the data aggregators need to get better about treating everyone equally as suppliers of data, right? Because much like anything, you have customers and you have suppliers. And generally, you don't want to mix those two. And so my theory, and I think I feel pretty good about this theory, is that the reason that like BNPL providers, as an example, don't have good coverage when you use a service like Plaid or you use a service like Finicity is because they don't want to share. And they were sort of considered by the aggregators to be their customers. And so the aggregators didn't want to piss them off the same way that they did with banks by scraping their data, which they absolutely could, the same way that they scrape banks. And so it's in some ways more of a business consideration than it is a technical limitation. And I think we may see the data aggregators take more of a broad-based approach to building coverage, particularly if 1033 does go away. But it's just another thing to monitor. The other last thing I want to mention, and then we'll move to our next story, is just real quick for my credit risk and data scientist nerds out there. FICO's approach in combining multiple BNPL loans into one larger installment loan, I believe, is more a decision rooted in the convenience of fitting it into existing attributes and ways of thinking about credit scoring than it is the right way to analytically treat this new product type, which is fundamentally different than an installment loan and different than a credit card, right? Like it is a different trade line type that I believe the bureaus and FICO should be adapting to in a more fundamental way. And, just for whatever it's worth, the reason that FICO has to make this a new score that lenders can get access to, and in fact, the reporting suggests they're giving away this score with the new FICO 1010T just as something for lenders to use for free to experiment with. The reason they're doing that is the older versions of the FICO score are not backwards compatible with this approach because the credit bureaus are not storing BNPL data as one aggregated installment loan. The credit bureaus are trying to store this data on an individual loan by loan basis. They're trying to treat the data as distinct loans. FICO is saying, no, we want to bundle it together into one installment loan. So there's a bit of tension there between FICO and the credit bureaus. And that's why FICO had to release it as a new score rather than sort of integrating it into all of the existing scores. So just a little point of clarification there.
Love going into the weeds. But is it necessary to make a little trip?
Yeah, I think it is. Jason, I don't want to, but I feel like we have to report on the fact that, as you wrote about it in your newsletter, there might be a rescue ship headed for BaaS Island. Is that right?
That is true, and we are going to torture this shtick until the very end. I'm
You're
committed
to the bit. Yes.
I'm committed to the bit. Yes. So there is a ray of hope that Synapse end users, Synapse depositors, could be rescued from BaaS Island. So the state of play is in what I can only describe as like jaw-dropping, totally gobsmacked.
Yeah.
And we'll get into all of the reasons why, but the Consumer Financial Protection Bureau filed a brief 4-page statement of interest in the Synapse bankruptcy case. The fundamental ask in that statement of interest, which was specifically in relation to the trustees' motion to either convert to a Chapter 7 liquidation or to dismiss, was the CFPB asking the judge to keep the case as a Chapter 7. Specifically because the Bureau, quote, has reason to believe that Synapse may have engaged in unfair practices by failing to properly track and reconcile consumer funds across partner financial institutions, end quote, and that the Bureau is going to conduct additional fact-finding in order to establish that claim and attempt to quantify consumer harm. Now, the reason why, and this is within the 4-page statement of interest, the reason why the Bureau is doing this is that it could allow the CFPB, should it secure a final order against Synapse or Synapse Estate that includes some penalty, even if that penalty is, this always makes me think of Price is Right, even if the penalty is $1, there has to be some nominal penalty.
Okay.
But if the Bureau is able to secure that, it can tap the civil penalty fund to potentially make depositors whole. The reason why the Bureau is asking to keep this in Chapter 7 is that would allow the CFPB to go through this process with the Chapter 7 trustee, which, as I understand it, would not be Yelena McWilliams, the current Chapter 11 trustee. It would be somebody else. Versus if the bankruptcy case is dismissed, the CFPB would need to file a new separate federal complaint, which would be a longer, more time-consuming process. So again, somebody texted me this information at like 10 p.m. on a Friday.
I think you texted me pretty soon afterwards being like, holy shit.
Yes, I did. I mean, my first sort of question to you is, under Russ vote CFPB? What?
Is that Russ vote music I hear? Oh my goodness, he's coming into the ring.
I mean, there's a whole lot of reasons why I was surprised. I mean, but that was sort of the first reaction, for an administration or for a acting director. And as a quick side note, the person who is nominated to be director seems to no longer want that job, and now I forget what job he has. McKernan,
Treasury, yeah.
He went over for probably smarter. So the idea that the Bureau that is under leadership that is actively, essentially at war with it, would pursue this, I am very glad that they are. I just found it incredibly surprising. And I've done asking around. I continue to ask around. No one has like a very convincing theory of like why and why now. So we're really just in speculation land. But I guess my question to you, Alex, is this a fintech bailout?
Ooh, that's a good question. So, yeah, I mean, just to put a little color around this, the civil penalty fund is this mechanism, right, that's existed since the CFPB was created. It's funded by the penalties that are paid by companies that end up in enforcement actions with the CFPB, right? And so it's kind of this fund that gets funded through there. I can't remember, Jason. It's kind of in the range of like $2 billion, right? Like it's a lot of money.
So I actually got some pushback on this. There are different numbers floating around, which makes it a little bit confusing.
Yeah.
referenced a 2024 Inspector General report, which stated that like the aggregate balance was around 2 billion. There are certain commitments tied to those funds. So you may see numbers that say like uncommitted or unencumbered balance might actually be considerably lower in the range of like 100 or 200 million. So there are some different stats floating around. Presumably there's going to be a lot less money coming in since the Bureau unilaterally dismissed a bunch of cases that were in process.
That's the thing is that like I don't, it's funny because I don't get the sense from Russ Vogt in any way that they're trying to put more money in that fund, to your point about enforcement actions. And there was also a recent statement from Vogt and the CFPB that they were specifically going to move to not spend any of that money on consumer education, which is the other allowable use under Dodd-Frank for that money. Now, I will say hardly any of that money has been used for consumer education over the last 14 years. And so it's more of, I think, a symbolic gesture that we're not going to do this than like a practical, we're stopping this, slush fund being used in this way type of thing. But all of that is to say, I didn't really get the sense that he had any interest in using this fund for any purpose at all, or refilling it or keeping it active in any way. And then here comes this news that, oh, no, we're going to take care of the Synapse users. I mean, I guess I have two reactions on the bailout thing. One is I do think it's really good that not only potentially will Synapse end users get some financial relief at the end of this. And again, we stress potentially because there's a lot of steps between this and there. But that just makes me happy on a personal level. I also think the fact that it has to be tied to more fact-finding being done is incredibly important because, as you've been banging the drum on more than any single person, regulators seem to have expressed no interest in trying to get to the bottom of what happened here, right? There's much more of a feeling when you look at like the Fed or you look at like state of Arkansas or whomever, the FDIC, like, we don't want this to be our problem. We don't want to get to the bottom of it. We don't even really want to find out what happened. Like, there is this lack of transparency into actually finding out what happened. And of course, Yelena McWilliams only had so much that she could do as a part of what she was doing, that I want to just get more information. So the CFPB digging into it to the degree that it has to make this happen potentially is interesting to me. I guess, Jason, bouncing it back to you, I guess the risk when we use the word bailout is this idea of moral hazard. Does this create that risk in your mind?
Deep sigh. I mean, I will get to that. I mean, I'm not entirely confident that the CFPB pursuing this is going to deliver what you just outlined, which is like greater transparency and greater accountability.
That was a hope on my part. I don't know that that's realistic to expect.
That I mean, if you're playing the hopeful, I will play the counter argument, which again, to be very clear, the number one priority should be, and I hope is, making depositors, making end users whole for funds that have not been returned to them. And then as a potential secondary, any losses that they incurred because they did not have access to their funds. So, I mean, if they had, they got evicted, they had their car repoed, like if you have not had access to your money in a year, like chances are you've incurred some other hardship and some other expenses. However, shifting gears, once those end users, should they be made whole, sort of any pressure to continue poking on this is diminished by like 99%, right? And so, the cynical part of me, and I think I've earned the right to be cynical on this one, is, okay, the CFPB has done, publicly anyway, absolutely nothing.
Yes.
Zero for more than a year, including under former director Chopra, who, didn't shy away from taking on, let's say, legally implausible fights, Capital One interest rate case, among others, or pursuing Google for products that it had sunset. And so, I don't, we don't know what's happening behind the scenes. I've tried to find out. We still don't know. I generally try to avoid too much speculating in public. However, with other avenues being exhausted, with the bankruptcy winding down, using the CFPB civil penalty fund to pay out consumers, in all likelihood, makes this situation go away, right?
Yeah.
It
It
consumers,
just stops.
including, I interact and talk with these people from time to time. It's like they care about getting their money back. Are they understandably angry and want somebody to be held responsible? Yes, but my sense is once you get your money back, 99% of these people just want to move on with their life.
The fight's kind of over for them. Yeah.
And so the desire to spend their time calling their representative or calling the St. Louis Fed goes away, right? And so tap the CFPB, pay these people out. I'm happy if they're made whole, but then this thing gets quietly swept under the rug and we move on. I do have to quote Fed Chair Powell's response at the House Financial Services Committee hearing last week. I did not tune in live because I don't have 3 hours in the middle of the day to do that. But somebody flagged it to me, and he was asked a question. I'm forgetting which representative asked it. But Powell's response, and I will just read it in its entirety because it is short, was, "I don't have a lot of specifics for you on that. I'm assured that we're still very much doing everything we can to get people their money back and to avoid similar occurrences." So just a total non-answer. To try to answer your question about moral hazard, I mean, I'm not an economist by training. I do know what that term means. The way I'm trying to think about that is, does this situation set the expectation that in some future fintech failure, the CFPB civil penalty fund would be there to bail out that situation? It's also worth noting that, at least as far as I understand it, that civil penalty fund can only be used if the company itself that is the subject of the enforcement action lacks the resources to pay compensation to the victims. And so you're really talking about a scenario where basically, a fintech or whatever, non-bank financial company has essentially gone bankrupt and owes customers money, but does not have enough money to repay it. And so, that feels a little bit different than some of the conversations 2 years ago now around systemic risk exception or too big to fail. So I'm not sure I would, jump to that point of concern that like, oh, okay, well, now as a fintech or as a bank partnering with a fintech, I'm not worried because at the end of the day, the CFPB is there to backstop. Like, that's not really, that's not a reasonable interpretation of what's happening.
No, like the CFPB is not like on the cusp of becoming the fintech FDIC, I bet, basically is what we're saying. So no, I mean, I think that's totally fair. I think the other thing that I think is just worth repeating, because again, we've been trapped on BaaS Island so long, we sort of lose sight of some of the main things. Jason just made a signal of unhappiness as it relates to being trapped on BaaS Island. So speaking of your cynicism, like, you have this long beard, you've made friends with a coconut, you've like used your shirt to like make fire, like it's getting dire for you. So I understand. That's why I'm not as naturally cynical on the story as you, I think. But the other part with the Synapse thing is, if banking as a service relationships, arrangements, structures, however you want to describe it, if those things worked the way they're supposed to work and didn't have whatever the sort of mysterious collision of problems were that happened with Synapse and Evolve and all of the programs that were working on those platforms, we wouldn't really have a problem here, right? Like, I think one of the things that's interesting about this is that in theoretically, the idea that, banking as a service is just this very thin slice that sits on top of regulated banks with accurate ledgers that keep track of customers' money that are indeed FDIC insured and backstopped by the government, that model should, in theory, pose very little risk to needing bailouts in the future. Now, as we saw with Synapse, that's not what happened. We still don't exactly know what caused the shortfall in the first place. There's some mysterious hole at the bottom of this that we still haven't been able to get to a good understanding of. However, like theoretically, if we have better record keeping, if we have reconciliation, if we have less of these sort of multi-layered and confusing models, I actually think the theoretical risk of needing a lot of bailouts of fintech companies should be a lot lower, right? Am I like misunderstanding that or thinking about that wrongly? Like, this doesn't seem like, as bad as the Synapse thing was, it doesn't seem like it's one of those things where, oh, we better come up with some backstop for this because this is going to happen a lot more in the future. Like, I just don't think this model makes sense. Now, stablecoins or other versions of this in the future, we could have a different problem there. But for banking as a service, I just don't see a huge moral hazard risk on the horizon in the future. Is that a fair assessment?
Yeah, I mean, my position on this has remained largely unchanged. Not that I don't think there are other potential examples of reconciliation challenges.
Yeah.
But the sort of unique and idiosyncratic set of events that led to this particular problem at this scale, I think is hopefully, fingers crossed, a one-off. The places, and we don't have time to go down this road today, but the places that I would be more concerned are, what you're referencing with some of the emerging stablecoin stuff, and then also what Dan Ari's work talking about like MTLs, and those are the places where I would see more concern, or to the extent that there are quote unquote fintech businesses that are not operating within the bounds of what they're supposed to be doing, right? And so taking sitting in the flow of funds when they're not licensed or regulated in a way where they should be sitting in the flow of funds.
Yeah. No, I think that's right. I mean, it feels like there are ways, and we'll see what happens with some of the rulemaking stuff that was going on post Synapse and how that carries forward into this administration. But it seems like there are ways to address some of those more systemic challenges that would even further reduce the risk of this kind of black swan event that we've been going through. Mikula, before I let you go, let's do this. We have our Can't Let It Go's, which we'll get to. We also have, I'm going to consider it sort of a bonus Can't Let It Go for both of us, which is Bill Pulte, the director of the FHFA, which oversees Fannie and Freddie, oversees the federal home loan banks, a whole bunch of interesting things. He is an amazing follow on Twitter, I will say, just because he's very addicted to using Twitter and sharing his feelings on Twitter, even doing like sort of regulation on Twitter and rulemaking on Twitter, which is fascinating to watch. He recently announced one piece of news that I thought we both should briefly comment on because it's sort of absurd from my perspective.
He tweets a lot.
A lot.
I just followed him and man.
It's mostly trying to get Jay Powell fired. That's a huge part of his Twitter arsenal. Although I will say, hearkening back to our earlier FICO score discussion, he also has trained a lot of fire on FICO and the credit bureaus around the cost of mortgages, making their investors a little nervous. So he's kind of a loose cannon. He fires all over the place.
But yes, I guess in response to, speaking of Twitter, my understanding is a user on Twitter asked or suggested, we're recording this on Friday, I think it was like on Monday. Yeah. And like by Wednesday, Pulte is tweeting like, I have ordered Fannie and Freddie to undertake like a study to prepare their businesses to accept crypto as an asset for the purposes of underwriting mortgages that are sold onward to the GSEs, which I'm going to admit I don't at this point fully understand the potential impacts of that happening, other than it sounds bad.
Yeah. Yeah, I mean, that just touches on a couple of things really quickly, right? One is he has this tendency to just sort of like say on Twitter, we're doing this with no like sort of traditional processes around notifying the staff at his agency. I mean, he just like does this via Twitter. So this is not uncommon. He also, I think, treats Twitter as a very direct way to speak to his boss, which is, in the year of our Lord 2025, probably a good strategy if you're working in this administration. So I get that. The crypto thing, I mean, obviously we're trying to become the crypto capital of the world. So I guess this is part of that. The thing I don't get about it is, according to the latest Federal Reserve data, something like 8% of households used crypto in any fashion in 2024. That's not very many, right? So like if you were approaching this from a first principles perspective of like, what is a form of wealth that a lot of consumers have that isn't able to be taken into consideration by mortgage underwriters that we want to make taken into consideration to unlock access to the American dream, I don't think crypto would be the number one thing that you would pick, nor do I really understand how you're going to price in like the volatility of crypto, which assets are acceptable, which assets are not. There's been lots of jokes online about, Fartcoin being, an asset that's used to underwrite a mortgage. Like, obviously, you wouldn't want to do that. So I guess we'll see what Fannie and Freddie come back with based on this instruction that's been handed down to them from Twitter. But pretty bizarre and pretty fast moving, to your earlier point.
I mean, this may be neither here nor there. And again, I will caveat this by saying all of the like FHFA, like Bill Pulte and GSE stuff, it's been like in my periphery, like I'm noticing it, but I've resisted going down that rabbit hole because like I can only, you
can only be obsessed with so many things.
But the idea that, and correct me if I'm wrong, but that there's all this pressure to reprivatize Fannie and Freddie, but like simultaneously you are going to tell them
to do
even though you're
stuff.
Even though you're becoming we want you to become a private business, we're also going to force you to take this highly volatile asset that, to your point, something like 8% of the country has and use it for consideration on their mortgage.
Yeah.
I know that it's, incredibly naive at this point to expect any kind of like ideological consistency. That's just not, governing is just performative on TV or on Twitter at this point. That this fits very neatly into that bucket.
It does.
As I scroll Pulte's feed and see him just like retweeting like Michael Saylor and David Sachs and
I mean he's right in the middle of the nexus of online policy making and politics. I agree though. I mean it's not consistent philosophically at all, and it also is just there's this like idea that crypto is the new rich in a way that I just don't think is squared with the data. Like, I mean, crypto is the very loud rich, the very online rich. I don't think it's like representative from a data perspective of like the new way that people are building wealth. And so all of these ideas, we didn't get a chance to talk about, Coinbase launching a card on American Express. And I tweeted about that and people were like, oh no, it makes sense to be on American Express because, Bitcoin is the new rich. And I'm like, is it? Like, maybe it is, but I don't think so. And all of the unbiased data that I've seen suggests that it's still a pretty small minority of folks who are holding a lot of their assets in this asset class. And so I find it kind of bizarre and to your point, performative. Mikula, let's do Can't Let It Goes, and then I will let you go. You go first.
Okay, so as listeners are undoubtedly aware, I live in the Netherlands. The Netherlands basically has three big banks. ABN AMRO is launching its own digital bank brand, which I don't know if this is pronounced differently in Dutch.
I wanted to make you pronounce it first because I didn't want to be the first one to do it.
It is spelled BUUT, which I'm just going to pronounce as but. I will ask a Dutch friend later if there's a different way to pronounce that. following in the great tradition of establishment banks, like launching these for some reason they're always like jaunty. Like I'm looking at the graphic and it just looks like somebody looked at Cash App and they're like, yes, this is what we need. Like we need these colors and like this sort of like typography, and it's like kitschy and like whatever. And for the most part, these things fail for one reason or another. I was doing some quick Googling. Everyone will remember Chase Fin, of course, which just felt like wildly unnecessary. It's like, if you're a JP Morgan Chase and you spend, I assume, hundreds of millions, if not billions of dollars a year on marketing, why do you want to go build this like separate sub brand that's only for markets where you don't already have a branch footprint? Why do that? I'll admit, I had never even heard. Apparently, Wells Fargo tried something like this called Wells Fargo Greenhouse, which I was not aware of. In the UK, RBS, Royal Bank of Scotland, had one called Bow, which was like they shut it down after like 6 months. There are some that are running, but my sense from looking at stats, including App Store downloads, which are available on whatever Google's calling their App Store these days. Michigan State University Federal Credit Union, disclosure, I'm an alumnus, has 2 brands, Alumnify, Collegiate, neither of which look like they're particularly successful. People's Bank has one, Zinlo. I don't know why banks keep doing this. Instead of fixing their own existing tech stack and UX, going and launching these like sub brands that very much feel like they're projects run by, no offense, people that are our ages, for people who are like 15 or 20 years younger than we are. And it's like, well, wait, is the problem that like your font and color scheme were too serious? Or like, is there some other fundamental problem of why you are unable to attract and onboard this customer segment who in the Netherlands is using other services like Bonk, which is a different bad name that does not translate well to English.
Right.
One actually very quick anecdote, and then I will let you can't let it go. I actually tried to open an account at ABN AMRO when I moved here for my business. And they told me, your visa is only for 5 years. Sorry, go away. Actually, sorry. I filled out reams and reams of forms, like a web form.
Then they told you that.
Had a phone call, and then they told me that. And then I went and opened an account at Bunk.
Right.
So it's like, is the reason because the fonts aren't like crazy enough, or is the reason because your actual website and app suck?
Yeah, no, it's a great point, and I think not to be, I'll take your place and be even more cynical on this one, but like this is one of those things where like a consultant got paid a ton of money to give really bad advice to spin up a thing that's not going to work, right? And that was the story with Finn and Bo and Greenhouse. Like it was I can see the like. I'll just pick on them. Like, I can see the McKinsey deck.
It's always McKinsey.
It's always McKinsey. Like some like 30-year-old at McKinsey pitched them on this idea. They sold them on it. It would cost hundreds of millions of dollars to stand up, and it never made any sense because your problem isn't colors or a fun name or a fun brand. Your problem is that your bank is difficult to work with. I do think there are niche digital banking plays that can make sense, but they have to be focused on utility, on functionality, on solving problems. It's not brand, color. And when you sent me the link to this one to Butt, which is wild, I looked at it and I was like, oh my, this takes me right back to the Bo, Greenhouse, Finn days. They're just apparently you guys in the Netherlands are like 10 years behind on this trend, but I don't know that it's going to go well for them.
Probably not. What can you not let go of this month?
I'll do this one super fast. Circle, the issuer of the stablecoin USDC, has gone public and currently has a market capitalization of approximately $56 billion. This valuation is based on a stock price of $248 per share, following a 700% increase since its IPO. Jason, I apologize for swearing at the very end of the podcast, but what the fuck? Like, why is Circle worth this amount of money? Like, I like Circle. I think they've done a pretty good job of building like a regulated, trustworthy stablecoin in a world that was previously being dominated by Tether. Like, I generally admire the approach they've taken relative to others in their space. They are not worth this money. Like, what is happening? I mean, even dyed-in-the-wool crypto believers who have every incentive in the world to just go along with it and to not say anything, even they can't stop themselves on Twitter from being like, whoa, boy, like this is this is crazy. I mean, as soon as the lockup period ends for employees and investors to sell their stock, I just can't imagine. We don't give financial advice on this podcast, but I cannot imagine that stock price doesn't go down. I mean, this is crazy.
Yes, I was trying to quickly Google what bank was comparably sized, and that is worth 2 fifth thirds. Which hold on, that's 10. I didn't even mean to go there with a joke, but it is apparently 10 thirds. I guess I don't know. My mom's a math teacher, so I got to do the fraction.
My mom is too.
Yeah.
They'd be proud. So 10 thirds is what Circle is currently worth.
Yeah.
Absurd.
Yeah.
Absurd.
No, I mean I made this half joke, but also mostly serious comment on Twitter that it's trading like a meme coin, not like the narrow bank that it is. You know,
that's exactly right. That's exactly.
And
a
I
narrow
think,
bank
frankly,
is,
that's all the analysis we need.
No, exactly. Like a narrow bank is what it is, right? It's a utility. It's a narrow bank. It's a thing that grinds out a little profit, but really is never going to be outstandingly profitable. Stablecoin mania continues unabated, I suppose, for the moment.
The last piece I will add on that, which also many people have pointed out on Twitter, is Circle pays like half of its revenue to Coinbase.
Yes.
And so like if you look at the valuations between the two, it makes no sense whatsoever.
It makes absolutely no sense. And I will say, just to end this point, Coinbase is thrilled by this because Coinbase wants Circle to continue to exist as this other thing. Oh, hey, it's great. And meanwhile, Coinbase sucks out all the profit out of Circle, right? And that is a distribution partnership that is wild in its details, and the fact that Circle is going to continue apparently to exist as a very large, successful, really highly priced standalone public company, at least for the moment, is just another evidence that the market can remain irrational longer than you can remain solvent. So we will end it there. Mikula, as always, delightful to speak with you. I'm glad your travel has wrapped up for the moment, and we'll do this again next month.
Sounds good.
All right. Thank you, sir. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.